Do you dream of mastering the stock market without gambling your hard-earned money? In The Intelligent Investor, Benjamin Graham provides timeless principles for achieving financial success through disciplined investing. This book is not about getting rich overnight, but about building wealth steadily while minimizing risk. Graham's teachings, often referred to as the foundation of value investing, have influenced countless successful investors, including Warren Buffett. If you like this video, don't forget to support the channel by liking and subscribing. Stay tuned for some additional book recommendations with similar insights at the end. The Intelligent Investor by Benjamin Graham. Investing versus speculating. Graham begins by drawing a sharp line between investing and speculating, a distinction that many fail to understand. Investors versus speculators. Investors focus on the long-term value of their assets, carefully analyzing businesses and their potential for growth. Speculators, by contrast, chase quick profits by betting on price movements. Graham warns that speculation is akin to gambling. It's entertaining, but unsustainable. For instance, an investor might analyze a company's earnings before buying stock, while a speculator might buy simply because the stock is trending. The margin of safety. One of Graham's most critical concepts, the margin of safety, involves purchasing investments at prices well below their intrinsic value. This buffer protects against unexpected downturns. Think of it as building a bridge strong enough to carry twice the expected load. You're prepared for the worst. For example, buying a stock valued at $50 for $30 creates a margin of safety. Emotions are the enemy. Graham highlights that emotional reactions, like fear during a crash or greed during a boom, lead to poor decisions. Successful investors remain rational, buying when others panic and selling when others are overly greedy. The 2008 financial crisis, for example, created opportunities for those who stayed calm and invested in undervalued assets. Market movements don't define value. Stock prices fluctuate daily based on sentiment and speculation, but a company's intrinsic value changes slowly. Graham advises ignoring short-term price movements and focusing on the fundamentals, such as earnings and market position. For instance, despite temporary dips, Amazon's value has consistently risen over the years due to strong fundamentals. Bit to remember. Investing isn't a short-term game. It's a long walk. Stay steady, plan wisely, and embrace the margin of safety. Mr. Market and his mood swings. Graham introduces Mr. Market, a vivid metaphor for understanding the stock market's unpredictable behavior. Who is Mr. Market? Mr. Market is like an erratic business partner who offers to buy your shares or sell you his every day. His moods swing wildly. Some days he's euphoric and overvalues stocks, and other days he's pessimistic and undervalues them. Graham teaches that your job is to capitalize on his mood swings rather than being influenced by them. Volatility is your ally. Volatility often scares new investors, but Graham sees it as a gift. When Mr. Market undervalues a stock, it's an opportunity to buy. Similarly, when he overvalues it, it's a chance to sell. For example, during market corrections, high-quality stocks often become temporarily undervalued. Avoiding the herd mentality. Graham advises against following the crowd. Herd mentality often leads to bubbles and crashes, as seen during the dot-com bubble of the late 1990s. Instead, investors should think independently, focusing on data and logic. Intrinsic value is the anchor. Understanding a stock's intrinsic value helps investors resist Mr. Market's erratic behavior. By analyzing financial health, earnings potential, and industry trends, investors can identify whether a stock is under or overvalued. For instance, Warren Buffett famously invests only in companies with strong intrinsic value. Bit to remember: Mr. Market is unpredictable, but you don't have to be. Use his wild offers to your advantage and stick to your strategy. The defensive and enterprising investor. Graham outlines two approaches to investing, tailored to different risk appetites and time commitments. The defensive investor. Safety first. Defensive investors are the guardians of their wealth, prioritizing stability and minimal effort. Graham suggests focusing on a balanced portfolio of high-quality bonds and blue-chip stocks. For instance, investing in dividend-paying stocks or government bonds offers consistent, reliable returns with low risk. Defensive investors avoid speculative bets and stick to established companies with a track record of performance. The enterprising investor. Active and opportunistic. Enterprising investors are hunters, willing to put in the time to seek undervalued stocks with growth potential. Graham emphasizes that this strategy requires significant research, analysis, and a keen eye for market trends. For example, spotting a small-cap tech company with innovative products before it gains widespread attention can result in substantial returns. However, this approach is not for the faint-hearted, as it involves higher risks. The role of diversification. Don't put all your eggs in one basket. Diversification is a non-negotiable rule for both investor types. Defensive investors can spread their funds across sectors, while enterprising investors may combine high-risk picks with more stable ones. For instance, mixing real estate investments with a broad stock market index fund reduces overall risk while allowing for steady growth. Diversification acts as an insurance policy against unforeseen market downturns. Setting clear criteria. A compass for decisions. Graham underscores the importance of having strict investment criteria. These might include consistent earnings growth, low debt-to-equity ratios, or a strong competitive edge in the market. For example, refusing to invest in a company with inconsistent profits ensures a disciplined approach that avoids emotional decisions. A clear, rules-based strategy helps investors navigate the complexities of the market confidently. Bit to remember: whether you're defensive or enterprising, success comes from sticking to your strategy, diversifying wisely, and setting clear, actionable criteria. The mindset of the intelligent investor. Beyond techniques, Graham emphasizes the psychology and discipline required for long-term investing success. Think long-term. Patience pays off. Investing is not a sprint, it's a marathon. Graham advocates holding investments over years, even decades, to realize their full potential. Markets may rise and fall in the short term, but quality assets grow steadily over time. For example, Warren Buffett's long-term investment in Coca-Cola, held for over 30 years, has yielded extraordinary returns. Patience allows investors to ride out temporary setbacks and benefit from compounding growth. Stay skeptical, not cynical. Question everything. Skepticism is an investor's best friend, allowing for thorough analysis and avoiding traps like overhyped stocks. However, Graham warns against becoming cynical, as this can blind investors to genuine opportunities. For instance, an investor skeptical of sky-high valuations during a bull market might dig deeper into a company's fundamentals before making a decision. Balancing caution with curiosity is key. Discipline beats timing. Stick to your plan. Graham stresses that trying to time the market is both risky and futile. Instead, he recommends dollar-cost averaging, regularly investing a fixed amount, regardless of market conditions. This approach smooths out the highs and lows, ensuring steady accumulation of assets over time. For example, consistently investing $500 monthly into an S&P 500 index fund over 20 years can build substantial wealth regardless of short-term market swings. Invest in yourself. Knowledge is the ultimate asset. Continuous learning is a hallmark of intelligent investors. Graham encourages reading financial reports, studying industries, and understanding economic trends. For instance, mastering how to read a company's balance sheet or learning the basics of macroeconomic indicators can greatly improve investment decisions. Education builds confidence, sharpens judgment, and ensures you're equipped to adapt to a changing market. Bit to remember. The right mindset is the foundation of successful investing. Be patient, stay disciplined, and never stop learning. If you enjoyed this summary, check out the following books: Common Stocks and Uncommon Profits by Philip Fisher, Rich Dad, Poor Dad by Robert Kiyosaki, Think and Grow Rich by Napoleon Hill, The Millionaire Next Door by Thomas Stanley and William Danko, The Little Book of Common Sense Investing by John Bogle, The Psychology of Money by Morgan Housel,